Money laundering through lawyers, notaries, accountants, and auditors. Lawyers, notaries, accountants, and auditors are often referred to as professional gatekeepers because they facilitate access to the financial and legal systems. Criminals may misuse these professionals to establish companies, create trusts, manage client accounts, purchase assets, conduct mergers and acquisitions, or structure transactions designed to conceal beneficial ownership. Client accounts maintained by legal professionals can be used to hold or transfer illicit funds under the appearance of legitimate legal activity. In some cases, criminals exploit professional privilege, confidentiality protections, or the credibility associated with regulated professions to obscure the true purpose and ownership of transactions. As a result, gatekeepers are considered significant vulnerabilities within the AML/CFT framework. Gatekeeper laundering model and key risks. The gatekeeper laundering model typically involves the creation of legal structures, movement of funds through professional services, and integration into legitimate financial activities. Criminals may instruct professionals to establish shell companies, trusts, foundations, partnerships, or nominee arrangements that obscure beneficial ownership. Funds are then transferred through client accounts, escrow arrangements, or complex transactions involving multiple jurisdictions. The final stage involves acquiring assets, businesses, or investments that appear legitimate. Red flags include unexplained use of intermediaries, reluctance to disclose beneficial owners, unnecessarily complex legal structures, transactions lacking economic rationale, and clients seeking secrecy rather than legitimate legal or financial advice. Effective due diligence is essential to mitigate these risks. Trust and company service providers, TCSPs, and financial crime risk. Trust and company service providers, TCSPs, offer services such as company formation, trust administration, nominee directorships, registered office services, and corporate secretarial support. While these services have legitimate purposes, they may be exploited by money launderers and terrorist financiers seeking anonymity and control over assets. Criminals often establish multiple legal entities across jurisdictions to obscure ownership and movement of funds. Trusts and companies can create layers of separation between beneficial owners and assets, making investigations more difficult. Because TCSPs facilitate the creation and administration of legal structures, regulators consider them important gatekeepers within the global AML/CFT framework. Red flags associated with trust and company service providers. Several red flags may indicate money laundering or terrorist financing involving TCSPs. These include complex ownership structures with no clear business purpose, frequent changes in ownership or directors, nominee shareholders lacking apparent economic interest, offshore entities established in secrecy jurisdictions, and reluctance to disclose beneficial ownership information. Additional indicators include companies with no apparent business activity, unexplained cross-border transactions, unusual use of trusts, transactions inconsistent with stated business objectives, and involvement of high-risk jurisdictions. Financial institutions should apply enhanced due diligence whenever customers utilize multiple legal entities or trust arrangements that appear unnecessarily complex. Transparency regarding ownership and control remains a critical AML objective. Technology as an enabler of money laundering and terrorist financing. Technological innovation has transformed financial services while simultaneously creating new opportunities for money laundering and terrorist financing. Digital payment platforms, virtual assets, cryptocurrencies, online marketplaces, peer-to-peer payment systems, mobile wallets, and fintech applications provide speed, accessibility, and global reach. Criminals exploit these technologies to move funds rapidly across borders, reduce reliance on traditional intermediaries, and increase anonymity. The growth of decentralized financial systems and digital assets has introduced additional complexity for investigators. Although technology supports financial inclusion and innovation, AML professionals must understand how emerging products and services may be misused by criminals seeking to conceal illicit activity. Technology-related red flags and emerging risk model. The emerging technology risk model focuses on anonymity, speed, and cross-border accessibility. Red flags include rapid movement of funds through multiple virtual asset wallets, frequent transfers involving virtual asset service providers, transactions inconsistent with a customer's known profile, use of privacy-enhancing technologies, sudden conversion of fiat currency into digital assets, and activity involving jurisdictions with weak AML controls. Additional indicators include numerous small-value transactions, unusual peer-to-peer transfers, unexplained use of prepaid products, and frequent movement between traditional and virtual financial systems. Effective controls include blockchain analytics, transaction monitoring, sanction screening, customer due diligence, and risk-based assessments tailored to technological developments. Banking red flags indicative of money laundering or terrorist financing. Banks and other deposit-taking institutions encounter a wide range of suspicious activities that may indicate money laundering or terrorist financing. Common red flags include structured cash deposits designed to avoid reporting thresholds, unusual wire transfer activity, rapid movement of funds between accounts, transactions lacking economic purpose, and significant account activity inconsistent with a customer's profile. Other indicators include frequent cash deposits followed by immediate withdrawals, unexplained international transfers, use of multiple accounts to disperse funds, and transactions involving high-risk jurisdictions. Criminals often attempt to exploit weaknesses in customer due diligence and transaction monitoring systems to avoid detection. Banking Red Flag Detection Model. A practical AML detection model for bank centers on customer behavior, transaction behavior, geographic exposure, and account activity. Customer-related indicators include incomplete identification information, reluctance to provide documentation, unexplained wealth, and use of nominees. Transaction-related indicators include unusually large cash activity, sudden increases in account turnover, multiple incoming and outgoing transfers, and transactions inconsistent with business operations. Geographic indicators involve activity connected to sanctioned, high-risk, or non-cooperative jurisdictions. Account indicators include dormant accounts becoming active, excessive third-party transactions, and unusual use of correspondent banking services. Combining these indicators through risk-based monitoring enables institutions to identify, investigate, and report potentially suspicious activity effectively.